Welcome back to Rockstock Channel. It is Friday, May 30th, and today we have for the first time a good friend of ours, Ken Hoffman, who has been at McKinsey for a long time, and we've seen his work quoted, or McKinsey's work quoted, of which he was the lithium expert for that. And we've been on panels together. Ken was the moderator of a panel I was at last year at Fast Markets, which was kind of an election, debate format. Um, and he and I, as well as Rodney, will be at Fast Markets again June 23rd. As a reminder to all viewers, you can get a discount for that Fast Markets conference if you use the code RK15. So, Ken, welcome to the program. A major reason I wanted to have you on was in February, I was in Florida. I was on the beach, and there was a webinar that you did through Bloomberg Intelligence, and you were like, you had just come back, and I've referenced this in some of our videos. You had just come back from the Future Forum in Riyadh, and then you were at like the NatBat conference, I think, in Nevada, and you labeled this kind of like the tale of two cities where there was pessimism everywhere, but not in the Middle East. And that I found a few weeks later. A client of ours, Noah Lithium, sourced an investor out of Israel, family office, put $10 million in, and he was super optimistic as well. So, and we just had Trump in the Middle East touting, and gave a very substantial speech, talking about investment and how that region has been transformed. There have been a number of investments in lithium and battery supply chain in various Middle Eastern countries. So we haven't talked about the Middle East so much here, and so just wanted to hear your perspective. One about this dichotomy of optimism and pessimism, as well as what's happening in the Middle East. And you also have done a fair bit of work, I think, in Chile with SQM. We haven't talked a lot about that recently, but there's been a lot happening there with Rio now investing. And, there's still question marks, SQM, Codelco, how that's going to, play itself out in an election year. So we'll talk about those things. And, but before doing that, I guess, are you bullish, bearish, lithium? Like, let's talk about kind of, the market's very bearish. We have a chart here. We're going to put up a price chart. The data set only goes to mid-July, and the price has, since, fallen further. But I just did a bit of an analysis from the last market top, like it was like January, February 2018, to the bottom, which was, I think, October, November of 2020, was about 34, 35 months. The last peak, 80,000, whatever, was November 2022. We're now approaching June. We're like in month 30, right? Like, so if it follows that path, and we've been making an argument that it could, follow that path, we have maybe a few more months to go, before a potential recovery later this year, early next year, so anyway, so I just like, it's important to put in perspective, lithium cycles, booms and busts, but fundamentally, what's your view, on the prospects of lithium, the 1, 3, 5, 10-year view, and then we can dig further.
Sure. You asked a lot of stuff in there. In terms of what's starting with prices, I think your analysis is spot on. I think that, last time around we saw from peak to trough was around 11 quarters. I didn't go monthly, but it looked at quarters, and we're in the 11th quarter from the last peak. This is an industry that is like a lot of other commodities, but is completely different than other commodities. And where it's different is sort of the growth rate. I mean, you are continuing to see 30% plus growth annually in battery demand. I know the US, and again, we can talk about it, is sort of, oh, EVs are dead and everything else. Battery demand in the US remains incredibly strong. A lot of it's to stationary storage, which the US needs to add massively on. But if you look globally, demand continues to be super, super strong. And What that does in a market as new as the lithium market is it's going to give you incredibly high volatility, which is what we've seen in the past. So, what we've seen, and this will be the third cycle that we're going into, but in the first two cycles, prices were low, not a lot of new supply coming on, demand's chugging along. Demand's just chugging along. And then all of a sudden, you hit a tipping point where all of a sudden supply gets a bit tight, and then you see prices are off to the running. I think part of the reason why it's been so volatile is China. I mean, we know all the demands in China, but what's interesting here is Chinese consumers were often, or manufacturers often buy excess inventory because in the world of China, there's no cost of capital. So if I think the prices are going up, I buy material. If I think prices are going down, I sell my inventories. And that's exactly what exasperates such a tiny market as lithium into these huge price moves. And could that happen again? Definitely. But I think long term, what you'll see is continuation of really good prices. We probably are bottoming out this year. I don't agree with this. A lot of people, the analysts are just so whatever they see today is the extrapolation of the future. So, I remember when in October of 2022, I was the bear on a bull bear debate at the London Metal Exchange. And I was like, guys, it can't continue like this. You can't have prices that are three times the highest cost producer in the world. It's just no commodity can do that. And it did collapse. Today, I'm the opposite, saying everyone is bearish. And I saw UBS came out this morning with a very bearish note and saying, oh, there'll be oversupply for the next 5 years. That also cannot happen because you're right. No one's going to be building a lithium asset today. No one's going to be financing a lithium asset today. What that does is it dries up supply, and all of a sudden, we're going to be going on that roller coaster back up. And I think we're really close to that.
I mean, I guess part of what I'm struggling with my models is a few years ago, it was a lot of ex-China supply. So we had economic models, rates of return, how they operate, very transparent and so on. And you've raised a great point, which is cost of capital in China and how they view it. So if we are looking at the Western world, which says, I want a 15 to 20% IRR, otherwise I'm not building this. And we've got China that says this is strategic, go out and do it. We're having two very different approaches, coming to assets. So I guess it's making it harder for people like ourselves. And then you've got the complexity of CATL and BYD, which is more integrated, that says we've got government subsidies, we've got cross-subsidization of batteries or EVs versus lithium production. That's another layer of complexity as to how to estimate forecasts. So if China is dominating battery, because you've seen Northvolt and others tipple over and investment pull out cathode and EV production, how in your mind does one sort of pass and navigate that additional difficulty now of what looks like economically you shouldn't do? China maybe can keep going for longer.
Well, I mean, look, if I took a ball over to China and I dropped it, it's going to fall to the earth. There's gravity there, there's gravity here. So in terms of economic returns, they need them as well. So, and you have seen a number of Chinese companies shut down capacity longer, you're hearing 4 months shutdowns for maintenance, etc. I think again, the train there's differently skewed, but they are not making big investments in the lithium space. In fact, they're shutting things down. And again, I think what you saw was, demand's sort of been this 30% juggernaut. So every time, as we go forward, all of a sudden, you used to be talking about going from 500,000 tons of demand to 700,000 tons of demand, and in a 30% rate. Now you're at, roughly 1.5 million tons of global demand and 30% on that. That's a huge amount of lithium needed. And I do think what you're going to need is the prices to move up for both Chinese and non-Chinese to increase. I think the West is a lot slower on that, in terms of it's going to take significantly higher prices in order to, see the West start to reaccelerate spending relative to China. But on the other hand, in terms of their cost of capital, that's the manufacturers. What you do see is manufacturers will go out and say, I think the price of lithium's going up, we'll start adding. And then when they see the price too high and the price starts heading down, but they all move at once. We've seen this in the copper industry, huge, where you'd see millions of tons of copper build an inventory and then disgorge an inventory, really increasing the volatility of copper prices. Well, lithium is that on steroids. And so I think what you will see though is as the industry sort of soaks up this supply that's out there, supply gets cut off. You probably do need to see some more capacity cut announcements in the West, and I think you will. Then all of a sudden what's going to happen is that demand again is not going to stop, which is sort of weird because like in other commodities, demand goes up, demand goes down, and it's sort of you have supply moving with demand moving up and down, and those have to match. This industry is just higher, 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 like in terms of demand, which is great. And I think actually demand is going to accelerate with a lot of the new Chinese battery systems, which use double the amount of lithium that they have in the past. And those things will continue to chug along, whereas supply is going to probably again have to catch up. And we'll be sitting here probably a year to 18 months from now, and the price is going to be moving higher. We're going to say, where are we going to find all the lithium? I think the mistake investors made was as prices were soaring, people were like, oh, do you know how hard it is? It takes so long to get a lithium mine up and running. We know now in 2 cycles, it takes China around 18 to 24 months to bring new supply to market. That's it. I know it's hard for the West. It's not hard for China. And so that's going to be how you sort of work on these cycles is expect high volatility, but the volatility is going to be up and down.
Ken, just on that front, do you have any concerns or reservations around demand that BYD having huge price cuts in China, along with others, that they are potentially front loading demand for cars with excess overcapacity, production overcapacity, and low prices? So I remember quite a lot of analysts had sort of low teens for Chinese EV growth, demand growth coming up after 2024, and we're not seeing that, and rest of world. So is there a danger that they are front loading, and then when it's time for Europe and the US to do the heavy lifting, maybe that's not enough to prop it up at some point later in this decade?
Well, I mean, you've seen Europe really soar this year, and a lot of that is China coming into the European market. I think we think about it too much from a Tesla standpoint. Tesla is dying. I mean, literally, they have not kept up in this world. They have not improved their products. Their range and recharge time is exactly the same pretty much as it was 6, 7 years ago. And therefore, Tesla sales, who I think they're ranking number 10th in China right now in terms of sales, they are. The rest of the industry is seeing really robust sales. I think what BYD is trying to do, I think there's over 100 EV companies in China. I think they're trying to, sort of use their massive size to force out of business a lot of those smaller players. The overall market continues to grow very strongly, but I think BYD, as they grow and they become bigger, sort of like what Ford did 100 years ago in the car industry, is Ford constantly dropped their price and constantly put out the hundreds of car companies that were in the United States in the early 1900s. I think BYD is sort of doing the same thing. But what that does is, the good news is as you drop price, you incentivize demand. Not only for cars, but also, again, there's so many other places batteries are used, stationary storage being the next biggest. And one of the things I remember at McKinsey is years ago, we had stationary storage by like 2030, 2035 being like, 5% of the market. It's going to probably be more like 30% of the market. So there are a number of channels, and that channel is driven faster and faster the lower prices go. So I think I wouldn't worry at all about in terms of lithium demand. That will continue. And again, lower prices actually are good news, not bad news.
Ken, you mentioned, and you have a slide here we're going to flash up, that most metals will see tremendous increases in the amount per vehicle as pack sizes double. You're basically saying as battery pack sizes increase from roughly 50 kilowatt hours to more than 140 or more, demand for these metals will increase. And for lithium, you're saying average car going from 64 kilograms of LCE to 300 kilograms. Um, what's driving that?
Sure. If you look at what the Chinese have done over the last 3, 4 years, it hasn't been battery development. It's actually been pack development, which is a huge change. So, normally, what you have, if you're Tesla, is you have this cylindrical cell. Maybe I can show it here. And you'll have this gigantic pack at the bottom that is drawing all the heat from that cell down to the bottom. Now, that's a lot of effort to get the heat from the very top of the cell to the bottom of the cell, um, out of there. So what the Chinese have done is they've used prismatic cells, which are rectangles, and they create a copper lattice. And the copper lattice fits between each cell. Now, copper is a huge heat sink. It conducts heat very well, as we all know. And so if you have copper between each one of those cells, what you can do is greatly reduce the amount of cooling from the bottom because you're cooling now from every single side. That allows them to put almost double the amount of chemicals into the same space because you don't have that massive cooling system any longer. And that's how the Chinese have been able to today. I think there's 6 or 7 cars there with 1,000 kilometers range, and some of them can charge as BYD down to less than 5 minutes. Again, what they're doing is they're just pumping a lot more chemicals into the same spot. Another thing that Tesla missed on, you can't use this type of lattice with a cylindrical cell. You sort of need squares or rectangles. But because of that change, you're seeing huge increases in chemicals in the same spot. And therefore, that means a lot more lithium. And then over time, as you start to head towards things such as lithium metal anodes, again, you're greatly increasing the amount of lithium needed by the industry.
Okay. Do you appreciate that? Do you have forecasts for, 2030, 2035, 2040, what you think, lithium demand will be?
I think by 2035, you're probably talking in the 6 to 10 million metric ton range.
6 to
Um,
10 million.
yeah, I know that sounds
That's
high, but again, I'm thinking every number we ever had at McKinsey, every time we came out with another forecast 6 months later, we always raised our numbers significantly in lithium demand, and I think that will continue. And I think what people are getting wrong is not only the number of vehicles, but the amount of lithium for vehicles, and also, again, other applications, particularly stationary storage. And here tells you a few things. The Tesla Megapack, which is like a trailer, or a sort of a gigantic trailer, has about 3.2 kilowatt hours of electricity it can hold. CATL's latest has 9. Same exact container, almost triple the amount. And again, it's using this pack technology that they have and driving cost way, way down. And again, as these costs come down, lithium demand goes up. And I think that only continues because the electrification of everything is going to have such an unbelievable impact on our lives. Even, for example, all right, I want to charge a car in under 5 minutes. Well, I need a lot of electricity pushed really quick. What do? I'm going to dig up my oil tanks under all my gas stations and I'm going to put gigantic batteries under that. And then they'll be filling up all the time. It's more lithium demand. So I think it's more copper demand and everything else. But in terms of, overall lithium demand, I think people, and I always like to spend my time on demand because everyone focuses on supply and miners are so good at that. But I think it's the demand side that people are getting very, very wrong. And because of that, that's going to actually be the reason why you're going to see lithium prices rebound from these lows.
So Ken, is this the prize on the demand side then for you? It's the non-EV segments that people are sort of underestimating.
Yeah, I mean, I think, and it's very tough here in the US. I mean, the US has turned very anti-EV. Um, but I think the rest of the world has not. And I do think EV sales continue to grow significantly. I mean, I think they're more than 50% of the market now in China. They're getting close to 30, 40% in Europe. That's only going to continue to rise. And at a certain point, you just won't want to buy petrol because it'll be really hard to find a gas station because everyone's going to be electric. And then you just go to 100% pretty quickly. I think in the US, it's going to be those type of really innovative products that can give me 500, 600 mile range, can be recharged in 5 minutes. Then all of a sudden government policy doesn't matter. It's just a far better product. I mean, imagine an EV usually save between $2,000 and $3,000 a year on the average EV relative to internal combustion engines, both on the lower cost of electricity, of energy in the vehicle, and two, maintenance. you save about $1,500 a year. We did some work at McKinsey. You save about $1,500 a year of maintenance. When people realize that, and you're getting EVs as cheap or even cheaper than internal combustion engines, you're just an idiot to buy an internal combustion engine at that point. And that's why you're seeing this rapid changeover. As that comes to the North America, it's going to switch that over as well. But there are other applications, and particularly stationary storage. And remember, the management of Tesla said like 7, 8 years ago, they thought stationary would be the same size as EVs, 10 terawatts each. That's probably not a bad estimate, because you do have to find ways. Spain had all these power outages, and what was the reason why they had the power outages? Oh, we switched over to renewables. They had no battery backup to sort of sit there and protect the system. Now they're all trying to build these absolutely crazy amounts of electricity. And just to give you a data point, since I did some work on this, a data center came to us and said, how many of these Tesla megapacks would you need for a data center to have an emergency backup? 7,000 of them. And so, I mean, the amount of power and electricity and stationary storage you need is just unbelievable. And I think that is going to drive lithium demand.
That's a great point, and we've been talking about this all year. The data center growth and the hyperscalers, the Metas and the Googles are spending $75 billion, a year in capex. This is the biggest capex spend like ever by tech, and it's all on electricity. Some of them, a lot of them are natural gas. They're investing in nuclear, and America's leading in this data center growth. A few companies like NextEra Energy, America's largest utility, has said that of all of the, ways to produce electricity, nuclear's, post 2030, maybe 2035, and even natural gas, hard to get gas turbines before 2030. The fastest and cheapest to deploy are the renewables plus batteries. But I'm not hearing that so much out of the administration. Like, you haven't heard Chris Wright, or Doug Burgum, the Interior or the Energy and the Interior Secretaries, or Trump or any of his team, mention the word batteries, right? I don't think I've heard the word battery yet.
But Howard, it doesn't matter. I mean, if I'm running a utility, I care about my cost.
Right.
And, why are coal plants being, closed? It's not because of green people crying and saying, close down these coal plants. It's because they're very expensive. If you look at the cost, renewables, particularly with battery storage, is the cheapest form of electricity. As you're right, it could be installed really quick. So if I'm a utility, I couldn't care less what the Trump administration cares. I want to have the lowest cost electricity available for my grid, and I need my grid to be as reliable as possible. That's my job. Couldn't care less what any of those guys say. This is what I'm running in my business. And so this is the best way to do so. And I'll give you a quick story. I was in Shanghai, and this is like 6, 7 years ago. And I'm meeting with the second largest wind farm company in China. Absolutely massive company, multiple billions in sales. And I'm a stupid American, and I go in and I want to create small talk. And I'm like, hey, you're happy it's windy outside. And what does the CEO say to me? He's like, no, I'm pretty upset. And I'm like, wait a second. You're a windmill guy. Like, you should be happy with wind, right? And he's like, no, you don't get it, Ken. Once the wind kicks up over, I think it was 20 kilometers an hour, they have to start shutting down their wind farms, because there's no place for the energy to go, and they'll overload the system. And I said, well, wait a second, I'm a battery guy. What would batteries do to help you out? And he goes, if we could actually put large scale batteries close to our wind farms, our overall cost would drop by 40%. Now, wind already is really, really inexpensive. And if I dropped it another 40%, and that's why you're seeing states like Texas just massively invest in backup battery systems and stuff, it drops the cost. And I think that's what's really important. You needed to go from a global environment where you needed government to kickstart and get things off the way. And then from there, it's just a better mousetrap. And that's where we are today. And so it doesn't really matter in a certain sense what the government says, because it's out of their hands right now. Now it's up to the consumer. And if I'm a utility, again, I'm batteries backing up renewables, is the best way to sort of run my business. And so that's why you're seeing this huge uplift in demand.
Okay, but the batteries that they're buying are largely coming from China, right? And if there are tariffs on them,
It does, but
yeah, I'm just asking you, does it change the cost? If there are tariffs, does it change the cost if the solar kind of investment tax credits kind of go away? does the economics of solar and wind in the US, which are now lowest cost, fastest to deploy, does that calculus change if you remove the incentives? And on the flip side, the Trump administration is doing things to advocate coal again.
I get it. You won't see coal. They can advocate all they want. Again, it's a very high cost, no matter what the government wants to do, unless they're going to give massive rebates to build these things, which I don't think they would want to do. Again, the cheapest way to do it. I think what happens at the end of the day is if I quickly need to deploy, because these data centers are using up so much electricity, the quickest way to fix that problem is renewables. And you are starting to see some companies here in the US start to build LFP type of cells. I've been working with some companies out there that really do great stuff with building domestically cells. And I think in the meantime, the utilities are probably going to just have to buy these cells and pay the price because they need this backup capacity today, and they're just going to have to pass those costs along to their consumers.
Ken, and in terms of sodium ion in this mix, where do you stand with that in terms of eating into market share for something that's sort of size and weight agnostic, like stationary storage? Well, what are your thoughts?
Now, remember again, agnostic is a difficult question because the service center we did when we told them they needed 7,000 of those megapacks, space actually does matter. Like you don't have unlimited space. What I always wanted with the sodium ion and within McKinsey, I was the sodium ion bear. I just didn't get it because one of sodium ion's biggest problems is cycle life. And if you have stationary storage, cycle life is critical. You need something on the order of 8 to 12,000 cycles because it could be charging, discharging almost every single day. Sodium ion often isn't just salt. I mean, that's sort of the press's thing, like, oh, you just take a little bit of salt and look how cheap it is. In order to get cycle life, most sodium ion batteries need things like tin, lanthanum, other rare earth metallics in order to sort of put something within the lattice to sort of keep the pathways of electricity sort of flowing. Otherwise, it shuts down. And when you look at that, if you have big demand for some of these cells, the price of tin, the price of lanthanum, etc., will explode. And therefore, sodium ion won't be very cheap. And so I think sodium ion could have a small say. You will never see it in EVs, in my opinion, because I think lithium ions are just going to keep ahead of it in terms of cost and in terms of efficiency. And even in stationary storage, it could remain niche. When we talk to clients, we think that the price of lithium cells, LFP cells in China today are about $36 a kilowatt hour. Years ago, people were like, if it breaks 100, that will be great. Now it's 36. And when I talk to clients, I'm like, if you can't target $20, you shouldn't be making a cell. So all the clients I talk to, I'm like, are you targeting $20? They say yes. I'm like, okay, I think this could be an interesting product. And that type of decline in lithium cell costs will sort of keep things like sodium ion, which today I think even the Chinese admit they're close to $100 a kilowatt hour, away from ever becoming commercial because lithium just keeps its lead really strong. And again, ask the questions because again, often what you'll see is sort of the hype of people trying to raise capital and saying, "Oh, this is so great, it's so abundant, it's amazing." And then when you actually sit down and do your due diligence and ask exactly what is in the cell, they're like, "Well, wait a minute, if demand ever went crazy for this, you're not going to be cheap at all. You're going to be ridiculously expensive." And the canary in the coal mine was vanadium a few years ago when all some vanadium flow batteries sort of started being announced in the Middle East, which we should talk about. And then all of a sudden, like within 6 months, the price of vanadium went up like 700%. And a lot of people said, wait a minute, I don't want to invest in a vanadium flow battery because, if the price is 600% higher, it's no longer economic. And so I think that could be also the problem with sodium ion batteries is if it does need tin, lanthanum, something else, you're gonna be like, no, I don't want to be a long-term investor in that because the price could just explode.
That's interesting. I'd heard of space and recycling issues. I hadn't heard of, and then sodium like widely available, but I didn't realize this
Yeah,
tin and lanthanum.
I went to a conference a couple years ago and there was a big sodium guy and one of the questions, it was a very academic conference, was how are you getting the cycles? And they're like, oh, we need a lot of tin. Like, wait a minute, that's tin's a very thin market. That could be a problem.
Right. Okay. So you were bearish on sodium, but back in there, I remember you were like very bullish, hydroxide versus carbonate. And when we were representing Piedmont for a long period of time, there was this very famous McKinsey graph that all the hard rock to hydroxide people made was that like hard rock was cheaper, right, to get to hydroxide. Do you still hold that view, hydroxide versus carbonate? And do you still hold the view that, hard rock to hydroxide, given, Albemarle and Tangshi's problems in Western Australia have shown that it's not so simple.
Well, again, going back to I was talking in the very beginning of how has China innovated. When they were able to innovate and be able to put double the amount of chemicals into the same space with the new pack technology, all of a sudden that opened up LFP. So we had a thought that whenever we surveyed, every year McKinsey surveys 10,000 customers around the world. And I think they've been doing this survey for about 15 years. And for 15 years, and it doesn't matter where, you could be in Norway or you can be in Iowa or you could be in China or Japan, range and recharge are always the number one. Always. And it doesn't matter where you live. And so, you can't be like, oh, Europeans don't drive much. Filling your car with energy is a pain point for consumers. They don't like it. Whether I have to do it once a month or once a day, I don't like it. So range and recharge were always the most important parts. And we had thought at the time, well, we weren't thinking pack technology could change dramatically. We're like range and recharge are going to be important, and therefore it's high nickel cells. And okay, that's the way you're going to get to range and recharge. And as you know, in high nickel cells, you can only use hydroxide. And so therefore hydroxide was going to be the market. As the Chinese changed pack design and sort of surprised us big time, then all of a sudden you saw LFP come flooding back into the market. And as you know, you can use either hydroxide or carbonate to make LFP. It doesn't care what the lithium delivery is. It can use either, but high nickel must use hydroxide because it's water soluble and it won't gum up the nickel in the works because you just can't use carbon for many of the high nickel applications. So from that standpoint, you need carbonate and hydroxide if you're going towards an LFP, LMFP world, which is where we sort of started to head today. You could be carbonate or hydroxide. You just need to be cost competitive.
Okay. So,
It doesn't mean
what,
nickel batteries are going to be ended. They're just going to have a smaller piece of the pie.
yeah, I'm just thinking, but if you're a lithium development project in Europe or the US and you are thinking hydroxide, you know, Lithium America, Stacker Pass, Ioneer, they've shifted between carbonate, hydroxide. They ended up going carbonate. GM is going to take the carbonate. GM, with LG Energy Solutions now has a manganese, breakthrough, but other plans that they have, I think Ford with SK, I don't know if those are hydroxide. So I'm just trying to think if you were a spodumene developer, for example, and there's not much conversion, right? There's, Tesla is building their hydroxide plant in Texas, and Rio Arcadium is building hydroxide in Bécancour. But if you're a hard rock, would you go to carbonate or would you seek to go to hydroxide?
I'm a huge believer in new technology. And that's, been a big part of my belief that lithium prices come down over time is that I think technology can help drive down cost. And there's a really cool little company. It's private, but there's a cool little company in Australia called Novalith. And Novalith actually uses spodumene. And what they do is they grind the spodumene and then they put it through uh, carbonic acid. And what the carbonic acid does is it combines with the spodumene and they leach out lithium carbonate. What's really cool about this technology, if it works, they're in a pilot phase, this is you'll save about 8 tons of carbon by doing this. Because if you're using carbonate to make lithium carbonate, you actually it's a negative carbon product. Now, Europe will pay you for removing carbon. So if you about 8 tons of carbon less in this type of lithium relative to traditionally produced lithium. If you get 8 tons and Europe's paying you between $100 and $150 a ton for your carbon credits, and the company estimates they're about $1,000 to $1,500 conversion cost. In theory, if it works, you can actually take hard rock, ship it to Europe, and had no conversion cost to lithium carbonate with all the tax credits and math. That could completely change the hard rock market. So again, just like the Chinese changing pack, and we didn't see that coming, there very well could be some ways that the industry changes refining technology that drastically change the cost structure, which all of a sudden brings one product that you thought was started on its way out way back in. And I think that's really important for investors to understand. It's not only the asset, and it's not only the asset's quantity, but how am I actually going to get that lithium out, and what is the cost of that, and how can I use things such as carbon credits in order to lower those costs. And so I think that's where it becomes difficult, but you really need to sort of be a technologist on the refining side, not only on the mining side.
Okay. Um, uh, I want to switch to, or go back to kind of like Saudi Arabia and this energy storage. You have two slides from a deck you put together. It says stationary storage could be as large as vehicles and will lead to the way for the Middle East and North Africa. 30 plus ESS projects planned. Could you just talk about what you're seeing on the ESS side? And I'll make a comment I've made before. Trump, talks about fossil fuels, et cetera, like drill, baby, drill. We have a lot of oil, but here in Saudi Arabia, the most oily place in the world, they actually have a target by 2035 to be 50% renewables. So like, why shouldn't America have that strategy? But that aside, but they're implementing that with these ESS. Obviously, there's a lot of sunshine there, but yeah, can you just talk about what's happening in the Middle East?
Well, let's start with a little story. I was meeting with a very large oil company's head of strategy 3 years ago, and we were having dinner. And I said to him, "You're one of the biggest oil companies in the world. What do you think about EVs and batteries, etc.?" And he said, "Look, this is our internal forecast." So it wasn't McKinsey getting it anything. Their internal forecast was that by 2040 there would be no petrol sold in the West, none. And they thought that EVs will continue to get better. Again, you're already seeing it in China with 600-mile range cars and 5-minute recharge times. They thought that technology continues to move and petrol would just be eliminated from the West. Now, that's not all oil. You still need chemicals. You still need, plastics. There's a ton of, but there's going to be in the pie chart of demand, there's a sliver that is petroleum for automobiles and vehicles. They thought that would go away. And so they needed between now and then to make big investments to fill that hole. And lithium is really the only major thing that an oil company feels comfortable with. They think they understand the chemical side of things. They think they understand the hydrogeology side of things, etc. And they have excess capital at the moment. And I think the Middle East has come to that same conclusion. And so they are thinking about this on a very long term. So they couldn't care less about the current lithium price. They couldn't care less about analysts saying oversupply. They think there is a huge hole that will be formed in their demand. And so they're trying to fill that by making big, big investments in lithium. And then, like, hey, if we're going to make the investments in lithium, why don't we just make the PCAM? Hey, why don't we make the CAM? And they're even thinking, well, why don't we make cells? And there's a lot of talk over there about building LFP cells. Stationary is something domestically they know they can sell to. And then if they can get really good at that, perhaps they'll make automotive cells for Europe longer term. But that is, and the excitement over there over this is unbelievable. The two conferences I've been to in the Middle East this year, packed, tons of questions, standing room only, every speech I've given over there. And then the questions just come in and you're sort of like, wait a minute, I was just in the US and it felt like a funeral or something in terms of the battery and the depression. I'm like, over there, it's just, no, how can we build it? And almost every request I've received for work in terms of government, and I advise governments as well. And the number one request I get is batteries. How do we build a battery supply chain over here? How do we make investments? It's huge over there. And I think, and they're not only going to keep those investments to the Middle East, but in many cases, they're going to make investments around the world in order to, and you can see the Middle East is trying to become a bit of Switzerland here. China, we love you. America, we love you. Europe, we love you. Africa, we love you. They seem to love everybody right now. And they want to use their capital, use their expertise to be sort of a middling space for all the world's batteries to sort of either, material to be refined, etc. And so over there, it's crazy. You go over there, you come out like wow, you're on a super high for lithium and everything because they're so excited about it. And I think that's something that people need to sort of, wherever you travel in the world, you sort of have to see there's different ways to view things.
Ken, I guess that was one of the things, thinking about it when I saw that is their ability to tap into China's technology or skills seamlessly because, as you say, they're friends with everyone. And that to me is kind of a distinct advantage for them.
Definitely. I mean, you've seen again, they had Trump over there. They love him. They love him. They love him. The Chinese, they love him. I mean, they're really playing this role of, hey guys, you can have your own geopolitical issues, but we have a lot of capital. We have a lot of experience, in chemicals and refining and everything else. And they can sort of play all sides here. And I think they're trying to do that. And they understand, like, look, if we do really believe that in 15 years there won't be much petrol sold in the West, it's going to take us a long time to get from here to there, to get the expertise, to get the mines up and running, to understand how to refine, and et cetera, et cetera. So they're doing it now, and they're really interested to make investments.
And it also it's borne out, and if you've looked at these solar tenders that they've put out and the prices that have come through, is just standout when you don't levy any tariffs or what have you, and you've got ample space and do it. It's incredibly competitive.
Yes, and note that every one of those massive solar arrays has huge battery backup systems, tons of lithium.
So you've talked about a few things here, like so there's the ESS and the demand side, but you're also mixing in here like they're making investments in lithium supply side, and this is like Aramco, or others. I mean, is this DLE? Is this oil field DLE? So that I just want to kind of disaggregate, like on as a demand shock, right? Middle East could provide that, right? But also, they could be a refining hub. I know there's also Morocco is in the Middle East. So, can you talk about some of these gigantic ESS projects in detail that are on this slide that I have here? So there's 30 ESS projects planned in Middle East, North Africa. That was from 2021 to 2025. I don't know if those have all been built yet, and what the forecast beyond that is. And then we could talk about, you have another slide here showing, CATL and BTR, I think is in Morocco, BYD, Goshen, and a
They're
few
all
other
over
companies
there.
here. Yeah.
And as a matter of fact, I mean, you've probably heard about this Project Neo, and I think most in the West, what they know about it is this very long, thin city. Um, in Dubai a couple weeks ago when I was there, they presented. That's actually a very small part, and I think they scaled back that city significantly. But what a Neo really is energy projects. There are all
What
over the
is
place.
NEO?
These
I'm sorry.
massive.
I'm thinking of the Chinese EV company. Is that what you're talking about?
Project Neo is sort of this. They have this it's supposed to be like a 100-kilometer long, like
It's like a
600-meter
mega city
wide
that
city.
runs it
Yeah,
runs 200 Ks. I mean,
yeah.
it's
It's
the
it's
most
sort of a
ambitious
this
thing
crazy concept.
anyone's tried. Yeah.
So what I didn't understand until I saw the presentation by one of their I think it was their CEO in Dubai, is he's like, that's like a little part of it, and we actually think we're shrinking that significantly. Neo is 5 different projects. The other 4 are energy projects, just gigantic solar and battery backup, these massive sites that they are building. And they built some of them already and they continue to build them, but they're really trying to use their solar power prowess along with battery systems. And they're trying to, the idea is not only to supply their own energy because they're trying to build cities on the Arabian coast there, but they also want to export some of that power to other Middle Eastern countries as well. And again, in order to do that, you need 24-hour electricity, which means you need massive battery systems. And these things are, again, just, the drone shots are spectacular.
Okay. Do you think there could be a lithium supply surprise out of the Middle Eastern countries or technologies?
I don't think they're going to become the world's largest lithium supplier. I mean, I think they're very interested, but the quality of the brines there are not fantastic. The ppms in some of their wells are 20 to 50 ppms. So they have a lot of it, but it's very low grade. They do have some reservoirs that have significantly higher, but they're relatively small. I think what they're thinking is, hey, if we do have stuff, we'll try to produce it. But I think also to augment that, they're very interested in, say, bringing in hard rock from like Africa to build refineries there to process that as well, to become a bigger lithium producer. Because I do think they think, again, probably with Chinese technology, they'll become a big cell maker, particularly for the stationary market. And therefore, they're going to need a lot of lithium. And so I think they themselves will produce some, but they'll probably be a big importer, both of lithium product as well as ores from Africa.
So they're going to make the hard rock spodumene conversion in country
I think though that could be
using
one of the
Chinese
things they're looking
technology.
at, and again, depending on technologies and how they
Right.
evolve.
Okay. Let's lastly just switch to Chile, because I know you said, I think you advised, SQM in the past. Rio Tinto has made 2 investments in Chile, uh, and SQM just reported. And again, I think they're growing faster, than the market last quarter. The only company that's been able to maintain their market share. They blame the market for low prices, but they're as much the cause of the low prices as lepidolite or anything else. But what's your take on Chile, SQM, DLE technologies, that are being applied in country, and possibly at SQM with the Solar Futuro and also the Codelco dynamic?
I mean, look, it's very tricky there. There's a lot of politics involved, and it does seem, from at least the stuff I'm reading, that that the Codelco tie-up seems like it's a done deal. Um, um, if it's like Codelco, remember its primary purpose is to supply revenue to the government. That's what Codelco does. And so I think they're trying to figure out um, how to produce, which method to produce, etc. I know Codelco has been going up a pretty steep curve trying to understand the DLE. And so I think bringing in, it's interesting how Rio has, I guess in order to move the needle at Rio, they have to become absolutely massive because they're, one of the world's largest miners to begin with. And so they need huge revenues for it to sort of make sense. So it doesn't surprise, it surprised me the speed that they're in Africa. They're all over the place right now and all sorts of different mediums, etc. But I think, SQM, and again, with the way their brine ponds are set up, because they don't use DLE, it's a 2-year process basically from the time it comes out of the ground until the time product's delivered. So they can't really, they have to have a very long-term viewpoint because they can't turn it off and turn it on. And so I think that's why they're sort of out there just saying like, hey guys, and a lot of this may be due to 2 years ago, them thinking the market would be a lot better. And now sort of, with the products here, we got to do something with it. So um, I think they are capacity constrained in terms of what the government allows them to ship. And I think some of this might have to do with their quotas and how much material they're allowed by the government to ship. But I do think, they'll continue to be an important player. They're trying to maintain their global market share, although it will continue to slip because there's just so much they can ship. And again, I'm looking at this from a longer term view. And I think, what they're doing is just sort of fine. They shouldn't, it's not their job to care about short-term price movements.
It's interesting you say that. SQM doesn't care about that, but you said Codelco, that their focus is to maximize revenues for the government. Codelco doesn't yet control SQM. I have said in some of my writings that it's unfortunate that they have not sought that the policies they put in place have incentivized SQM to expand production as much as possible, as fast as possible. But if they put in incentives for them to kind of manage and have more discipline, the price of lithium would be a lot higher. And then the royalties going to the government would be a lot higher, right? So they're making much less money, the government, on the low prices that SQM is helping to cause. So if anyone at Corfo or CCHEN or anyone in Chile is listening to this podcast, and Ken, if you have any influence with the Chilean government,
I do not.
I would encourage you to speak to the powers that be. Is that Chile SQM is hurting the Treasury's coffers with their current lithium production strategy. But anyway, I'm sure that'll fall on deaf ears. But anyway, I just figured I'd
I mean,
say it.
also, look, they're the lowest cost producer in the world. You see right now in oil's down to $60. Saudi Arabia is sort of upset with some of the higher cost producers. And so they are driving down the price. It's not good for their coffers, but they're like, hey, we're the lowest cost producer. You better get in line. And I think an upside of SQM could be that you do see some more and more marginal producers shut, and then that hastens the price increase going forward. Because again, demand is going to continue to
Well,
rise no matter what.
that's a good point. It's a bad point. It exactly that. Like SQM did the same thing in 2020, and it helped put Altura out of business because Ganfeng reneged on their price floors for Altura and took SQM material instead. But Altura's bankruptcy is ultimately what led to, the huge run up. So the question is, will SQM, and these other low price actors, force, Wodgina to close, or Kathleen Valley, of Liontown to close? And if one of those come off, or Mount Marion, if any of those kind of come off, then you could have a similar situation where
It's always darkest before dawn.
things tighten up. So we shall see. The last question I have is, like, we talked, I remember we met at the Fast Markets conference all the way in 2018 and 2019 in Chile, and you were on a panel, with Javier from Morgan Stanley, and he was talking about, with all commodities, it's all about supply, it's not about demand. And then there was all this debate, about pricing, and you made a comparison of lithium pricing to aluminum, and basically saying that the lowest cost aluminum product, which was like garbage cans or aluminum cans, is actually what sets the price. The most liquid, lowest cost. So just from an analogy point of view, you said lithium's growing much faster than aluminum. I made a comparison of Albemarle to Alcoa in my most recent lithium bull. Maybe lithium's not like iron ore, maybe it's more like aluminum. Could you talk about compare and contrast, because you've done a lot of commodities over the years, growth versus commodity aspects? Is it more appropriate to think of lithium as aluminum, versus iron ore or some other commodity?
Yeah, there's a couple things there. One, I mean, I remember at that conference they were trying to compare lithium to chicken and rice, and sort of
Javier
saying,
was, yes, he
yeah,
was.
a commodity is a commodity is a commodity, was his point. And then the other side of that was, you don't know how hard it is to make lithium. You don't know all the expertise it takes. It is not, corn or something. Although if you talk to a chicken farmer, he'd probably tell you it's a lot more difficult than it looks to the eye as well. So from that standpoint, I think both sides were wrong. I think lithium is a relatively difficult thing to make. It is getting ever more challenging for it to make. And so you will see big price striations. Therefore, meaning if you're a really high quality producer, you will get a huge premium over sort of the listed 99.5, say, carbonate price. And so in that case, like aluminum, and you have me saying the American thing, I talk to Europe and Asian so much, I always say aluminium. So you will see really, and so those companies who can provide the ultimate product will get huge premiums. Now, on the flip side, what I said was and actually I think I might have been talking is aluminum or steel, one or the other. When buyers price their product, they're always going to use the most liquid price, and the most liquid is usually the most commoditized price. So, and that will be China. I mean, so what you always have is the lithium miners are saying, I want to use a Western price. And the buyers, be it, one of the big OEMs, is saying, I want to use the Chinese price. And that's the dance back and forth. But because it's the most liquid price, it is the most referenced price. And therefore it sort of drives the overall price of all products, because you're just like, well, that's the base, so I can buy a really crappy lithium in China, and someone's going to upgrade it and upgrade it and upgrade it to the premium. Yes, you're going to get the premium price, but it's always based off of that commoditized price. And I think that's sort of true. And so, so what you do if you're a company is, how can I upscale my lithium? So if I'm making lithium metal today, you're getting absolutely massive premiums. It's still based on it. The price of lithium metal always moves with the lowest cost lithium, but I will get a big premium. Or it could be, a lot of the lithium products aren't 99.5 that go into a vehicle. They're 99.7, 99.8. It's a premium to get you from 99.5 to 99.7, 99.8. Again, from the outside, like, what's the difference? It's really hard to make 99.7, 99.8. SQM famously said to me once, I was talking to the CEO, and he said, how much lithium do you think we sell to the automotive industry? A lot. He's like, I sell zero. Like, what do you mean you sell zero? Because he's selling it to re-refiners in China who are upgrading it for the car industry. He can't directly sell to the automotive industry because he's making 99.5 and they need much better quality than that. So, and there's a premium then. So I think that's where you sort of, as you look at your lithium production, and that's why, an Albemarle or a Arcadian Rio now, if you look at their prices, they're considerably higher than, say, a company that's just selling pure commoditized lithium. One producer who's at one plant is just selling a commoditized version of it. They're not getting all those premiums that the major manufacturers are.
Great. And one final question. Always we like to put our guests on the spot. When do you think, price will recover to, uh, 15, 20,000? Or do you think, yeah, so when and what do you think price should be, um, in the next, 1, 3, 5 years?
I mean, if we go to the last cycle, and I think these cycles could be pretty regular. We're bottoming now within the next 6 months. We start heading up in 2026, and probably by the end of 26, early 27, you're at your number of 15 or 20,000.
Awesome. Thank you very much, Ken. Really appreciate it. Rodney, unless you have any questions, we can end it there.
That's great. Let's hope that you're right, Ken.
At least remember, no one ever picked a bottom. No one ever picked a top.
It's a tough. That's true.
And so just realize that when everyone's being bearish, that's usually the time to buy. When everyone's being bullish, it's usually time to sell.
Yeah.
Right.
Fair enough. Thanks a lot.
Okay. Thanks. We'll
Yeah,
see you in
thanks.
Vegas.